Assalamualaikum. This is Principles of Accounting course, Chapter 6, Inventories, Part 3. We have learned about many significant topics in our previous sessions. Today we will be concluding this lecture with the disclosure method and some practice maths and the mini quiz. We will start a new chapter in our next class, inshallah. Before diving into our today's topic, let's talk about what have we learned till today. The first topic we have learned was classifying inventories. Either it is merchandising inventory or it is manufacturing inventories. There are some basic differences between them. Then we have determined the inventories, how to calculate them and in which method should we calculate, is it periodic or perpetual. Then we have learned about several inventory costing methods, LIFO method, FIFO method, average costing method or moving average method. We have also learned about LCNRV, which is lower of cost or net realizable value. Today, we will be learning about inventory presentation, analysis, disclosures in financial statements and some errors of inventory. And finally, we will have a small quiz session regarding our basic concepts. So let's today, starting with the topic inventory presentation and analysis. Let's first talk about disclosures. What should we disclose in our financial statements, in our annual reports regarding the inventory? What should we disclose about inventory? The first one is to disclose the classification of inventory. What are we inventorizing? Is it merchandising or is it raw materials or is it work in progress or is it finished goods? We should explicitly mention in our annual reports that which one is what and the measure and classification should be mentioned. Then, basis of accounting should be mentioned. Either did we choose cost or did we choose lower of cost to net realizable value? Which method did we use in calculating the inventories? We must mention or we must disclose that in the notes of our financial statements. And finally, we have to mention the cost method. If we used cost method, then we must mention the cost method we used. Either it is FIFO method or it is LIFO method or it is average costing method. Whichever it is, we must mention and we must explain the reasonings behind our costing method in the disclosure section. Then how should we present the inventory in our financial statements? Inventory must be classified under current asset in the balance sheet or in the financial statement of estimate of financial position. I repeat, inventories must be classified as current asset when we prepare the statement of financial position, which will add up to current asset, which will add up to total asset, and the cost of goods sold must be subtracted from sales in the income statement. The first item in the income statement is the sales or net sales, we say. Then, to determine the gross profit, we just subtract the cost of goods sold, and the amount of that cost of goods sold comes from this inventory costing methods. So we can face some severe errors while counting the inventories or while making inventory calculations. We can be doing incorrect counting, in fact physical counting. It can happen, and for that reason our statements cannot match. It can be distorted unintentionally because of physical mistakes of counting. Then incorrect recognition of ownership transfer. We have learned in our previous sessions that if there is a condition of FOB free on board, shipping point, or FOB destination, then there can be a problem arising. But if we cannot determine the ownership properly, then an incorrect recognition will be happening, and thus the inventory counting or inventory recognizing can also become very difficult. Finally, affecting both income statement and balance sheet is not some desired thing from the inventories. Inventory must increase or decrease the current asset. Usually it increases when we have inventory, but it should not affect the income statement. But cost of goods sold must affect the income statement, but should not come in the balance sheet. We must be careful about these issues. Then let's have a mini quiz on our basic concepts. The first one is goods in transit should be concluded in the inventory of the buyer when, let's see, goods in transit, which is in transport, should be included in the inventory of the buyer when, if public carrier accepts goods from the seller, or goods reach the buyer, or terms of sale are for destination, or the terms are for shipping point. Let's choose one. This is not the one. This is a wrong one. Public carrier accepts goods from the seller doesn't mean that it should be included in the inventory of the buyer. It is a charge. There should be a term. It is either the shipping point or it is destination. But when goods are reached to the buyer, should it be included? No, it shouldn't be, because again there should be a term. So 50-50 chance. It should be from destination or it should be from shipping point. So let's try the from destination now. Why? Because the from destination means in our previous chapter we have learned about FOB shipping point, FOB destination. FOB destination is when the seller pays the freight cost until reaching the destination of the product. So if it is paid by the seller, then it shouldn't be, then the goods in transit shouldn't be included in the inventory of the buyer. So this would be the incorrect answer when the term of seller for the shipping point. If shipping point means the buyer pays the freight cost from the point of shipping. So let's move on to the next question, which is cost flow method that often parallels actual physical flow of merchandise is the what? Let's see. Cost flow method that often parallels actual physical flow of the merchandise is it FIFO method that is parallel with the actual physical flow? Is it LIFO or is it average cost? Let's say this is FIFO method. Why? Because when a product comes in the inventory, you just label it as it came last. or it came first? Do you label it? No, we just keep it there, and we organize them in the basis of which came first and which came last. The first batch has limited or low expiry date, or very nearly expiry date, but the last one, which came today, has more expiry date than the product came in the last week. So we usually in the merchandising industry, or in the merchandisers usually do what? The product came the last, they keep that at the very last. So they usually follow the FIFO method in physical form. That's why we say cost flow method that often parallels actual flow of the merchandise is the FIFO method, and the others are very, very long, which cannot be accepted. Let's move on to our third question, which is: in a period of inflation, the cost flow method that results in the lowest income taxes is what? When time of inflation, the purchasing power of the people has been decreased due to inflation, and what should we do? Shouldn't we be doing the LIFO method? We should, because releasing the lost cane products first will be more practical. The others are wrong. Let's move on to our fourth question, which is the last. Understanding ending inventory. Understating ending inventory will overstate what? If we understate, understate means কম দেখানো, overstate means বেশি দেখানো. If we understate ending inventory, then will it overstate asset? Can you think of that? Or will it overstate the cost of goods sold? Where the ending inventory comes? It usually comes when we calculate the cost of goods sold, which is the beginning inventory plus purchases minus ending inventory. If we understate the ending inventory, then will it not be overstating the cost of goods sold, or will it overstate the gross profit? Let's see. First, we kick out the assets and average cost option. It is 50-50% chance. Let's see, is it gross profit? No, because it is directly, because any inventory is directly related to cost of goods sold. That's why if you understate or show less amount in the inventory, it will affect the cost of goods sold and ultimately gross profit. But at the very beginning, it will affect the cost of goods sold. Now, let's do a practice math regarding this chapter. We'll be doing it in Excel, and we will show you how we did that. This is a math from our accounting textbook, which I have already shared in our portal. You can download it and do some practice maths from there. I have also highlighted the important maths there, and which will help you learn and understand the costing methods even better. So let's do this math. The problem 6.5. We will be determining the ending inventory, the cost of goods sold, the gross profit, and in the LIFO and FIFO method. Let's see. The first one is the June 1. The date should be written first, June 1. The beginning inventory, the quantity is 40 and the selling price is 40. Let's write that, 40, and we'll calculate the total amount at the very end. Then at June 4, the purchase is, let's write on 4. Oh, sorry, there should be a balance column here. here the balance is 40 units, and the rate is 40. Okay, fine. Then moving on to the second date, which is June 4. June 4. We have purchased 135 units of products with 43 rate, 135 units, 43. So we should write that in our balance, which is we are doing it in perpetual method, so it will be 40 at 40 and 135 at 43. This is the balance of our first date, and now here we will add the units, only units, not the rates. Now we can see we have 175 units of products. Now let's move on to June 10, where we have a sale of 110 units. So let's write June 10, and in the sales column we will write 110 units, where the unit price is 70. Then at the LIFO method, we will take this amount from we will not rate this 70. We will omit that because that is our selling price, and we should not include our selling price when we determine cost of goods sold. So we are taking 110 units from 135 because it is LIFO lost in first hour. So the last amount inputted will be taken as the first amount going out. So we will take 110 units totally, and the rate will be 43. So how much we have, we will minus from this one, or it should be done like this. We have taken 110, so we will have 135 minus 110, we have 25 units at the rate of 43, and finally 40 will be taken completely. 40 will be taken at 40. So now we will have a total of 25 plus 40. 65 units at our hand. That is our current balance of inventories. And then we will input our 11th July sales return. What should we do now? June 11, as we have a sales return of 15 units, so we have to keep that as minus 15, and it will return to our inventory, which is at the last one. We have inputted, it will be interchanged as 40, and it will be 25 and 42. So it will be returned to the 25. So 25 plus 15 will get the 40 back, and the rate will be 43. Okay. But we will keep that at the end, but we have to keep the first one as first, 40. We are doing here LIFO method. So now we have a balance of 40 plus 40 equals 80. This is our current balance now after the sales return. Now we will see June 18. Here, June 18, we have a purchase of 55 units, so let's write that. We have written here sales, it should be cost of goods sold. sold. So the cost of goods sold, at June 18, we are having purchase of 55 units. So we'll write that in the purchase, and the rate will be as it is, 46 units. $46 per unit. So we'll write that in here. Before that, we have to write the 40 at 40. We have to then also input 40 at 43. And finally, the new one, 55 at 46. So the total amount will be 80 plus 56, 55. So total amount we have 135 units of inventories at our hand right now. Then finally, when we do a purchase return, then at June, so at the same date, June 18, we are having a purchase return. We also write June 18, then it will be as a purchase return, and minus 10 units. At the same rate, 46, and it will be deducted from the last one. So we'll write again the 40. The first two will be written as it is, and we will deduct this from 10, which will be 45. The rate will be 46. So that total value will be 125. And this is our current balance, current inventory at our hand. Finally, at June 25, we are selling 65 units of products. So we'll write that in our cost of goods sold. Units. So we are writing 65. Now what should be the rate? The rate should be taken from the last. 45 will become first at 46. Then we have only left 20 units. 65 minus 45 equals 25. I'm writing 65 minus 45. We only have 20 units, and we'll take that from this 43. So we have already taken 65 units, then the remaining 20 units will be calculated as 43 per unit, and the rest 40 units will remain as 40. So now we are having only 60 units at hand. Finally, at June 28, we will add the purchase in our purchase column, 35 units, and what is the rate? The rate is 50. 50. So the total amount will be 20 at 43 plus 40 at 40. So it should be written first. The 40 should be written first. 40 at 40 and 20 at 43. And 35 at 50. So the total amount will be 95 units at hand. Here should be written as 40, 40, and 23 as 43. Now this is the ending inventory, actual physical count of ending inventory. Physical count of ending inventory is 95. We didn't determine the cost of goods sold or the gross profit. Let's see if we can calculate the gross profit. Let's multiply the unit with rate. So the ending inventory amounted to 95 units, and which will cost us $4,210. This is our ending inventory. And what about cost of goods sold? We just add a column there, and we will, similar way, we will multiply the rates. This is our cost of goods sold. Sorry, this one. 110 units. This one is our one item, and we will be minusing that, or we will be subtracting that. At 15, which rate? The rate will be 40. Sorry, the rate will be 43 because last in last out, and 110 will be 43. And the universal, yes, we will accounting that. And so we can easily put formulas or multiply with the calculators and paste. And now we can add this. We have got our cost of goods sold at LIFO method, and what will be our gross profit. This one minus net sales minus cost of goods sold. So we have found that this is our cost of goods sold. What is our selling price? Let's see. Our selling price is 70,410. 110 at 73. So 70. And then our sales return of 15. Sorry, minus 15 and at the rate of 70, and the sales was 65 at the rate of 76. So we get, let's see, we got our total sales here. So let's sum that. We have got our selling price here. That is our selling price or SP. And how do we determine gross profit? Gross profit equals our selling price minus the cost of goods sold. That is our answer. So with the practice session, we are closing our we will be concluding our chapter 6 inventories. We will be taking a test at 18th August, Saturday, inshallah, on inventories and chapter 5, inshallah. Thank you very much for attending today's session. We will start a new chapter in the next session, inshallah. Assalamu alaikum.